Hey everybody, HotDogBoy here. Today I'm going to tell you all about call options and how you can use them to make money even when you're in a bear market. So let's get started with what a call option is. So, take for example this vase. You have an item of known value that could either appreciate or depreciate within a time span. Calls can be anywhere from a weekly call that expires in 7 days to a 2-year call that will expire in 2 years. So, if you have this vase, let's say right now the vase is worth $100, and HotDogBoy with no hat owns the vase. So a way that HotDogBoy with no hat can make money is you can write what's called a covered call. A covered call means you're selling a call option and you have the underlying asset versus an uncovered call, which are way more dangerous where you don't have the underlying asset. So, I'm going to make a bet that this vase, which is right now worth $100, is not going to be worth more than $110 in 1 week. So, today, October 26th, a 1 week call now would expire on November 2nd at the price of $110. So, I'm going to write this contract and I'm going to sell it on the options market. A November 2nd contract with a strike price of $110, assuming that this is right now worth $100. So I go out to the options market and I put this contract up for sale, and I'm going to sell it for $1. Another person comes along and they see the vase and they say, next week I have a strong feeling that vase is going to be worth $120. So, I'll gladly pay $1 for the right to buy your contract to buy it for $110. So the price volatility of this vase is crazy. Remember, the contract expires on November 2nd. So, come November 2nd, it's going to be its value is going to be determined. It could be 0 or it could be a positive number. So, let's say now it's October 31st. And the owner of the options contract who bought it from the first guy, HotDogBoy with no hat, sees that the vase is now worth $108. So HotDogBoy with the stocking cap starts to get a little bit worried because he said, I bought the right to buy this vase for $110. Right now the market price is $108. So right now this contract isn't worth very much unless the vase appreciates quickly. So he goes ahead, takes that contract that he bought, and then goes out to the market to try to resell it. So he goes back out to the market and says, this contract that I bought for $1, I'm now going to try to sell it for $2. So a third person comes into the deal, HotDogBoy with a baseball cap. And he sees that contract now worth $2, and he says, I think that vase could appreciate in value a lot by the end of this week, well above $110. I don't mind paying $2 for that contract. So he gives money to HotDogBoy with a stocking cap and buys that call option from him. Then comes the fun part. So, HotDogBoy with a baseball cap bought this contract for $2 at a strike price of $110. Now, let's say we're at the expiration date, and the vase is worth, lo and behold, $120. So, how much money did we make? Well, the vase is worth $120. We bought the right to buy it at $110, and we paid $2 for the contract itself. So, we've made $8. And that's the first way that you can make money on call options. If they execute, you make that difference of money, and if that is a positive difference, you've made money buying that contract. And those are 3 ways that you can make money with call options. You can sell the contract then you make money from getting the contract. That's the safest way to make money off options, is selling covered calls. You can trade the contract. That's, you buy the contract and then you wait for it to appreciate in value and sell it for more money than you bought it for. Or if the strike price is broken, you can make that money in the difference of you buy the actual item, which in our case is stock. In the example, it's the vase, and you buy it for less than it's worth because the contract allows you to do that. And then you can either hold on to it and wait for it to appreciate more, or you can sell it immediately and make that difference in price between the strike price that's on the contract and what the asset is now worth. So the price of an option is going to be based off of 4 things. One of them being the value of the underlying stock. So more higher priced stocks like Amazon are going to have more expensive calls than a lower price stock that's only $10 or $20. 2 is the volatility of the stock. If you've got a really low volatility stock that doesn't move around very much, like Ford, although it moved a lot this week, but let's say you have a Ford in a not very volatile time, the option is going to be cheaper because you don't expect the price to move around as much. 3, the strike price. So the closer the strike price is to the current price of the stock right now, the more expensive the call option is going to be. So if this vase right now is worth $100 and I sell a call that expires in 1 week for $105, that call is going to be more expensive for the buyer than a call that might expire in a week that has a strike price of $110. So the volatility, the price of the underlying asset, the time window, and the strike price. So the time window, if you have a strike price of $110 and the option expires in 1 week, that gives less time for the underlying asset to appreciate. Versus if you sell a monthly or a yearly option, that gives much more time for the asset to appreciate. So the option is going to be more expensive for the buyer because it's more likely to be profitable because you have a wider time span for it to be profitable. So let's start with a stock that has a pretty low price just so you might be able to buy it, to check it out. GE is currently at a price of $11.34. So 100 of those shares would be $1,100. You can sell a call today at a strike price of $12. That's a 6% increase that expires next Friday, and it's November 2nd, for $35. So if you're in a bear market, let's say you have 100 shares of GE, you really believe in the stock long term, but in the short term you think it's going to keep going down because Wall Street's getting nervous, the market doesn't look so good. So you want to keep holding on that stock for a couple of years, but also you want to make some money when you know that it's going to go down in the short term. So what I've been doing is you take these calls and you keep selling them every week. So a 6% increase on GE would bring it above $12. You can sell that contract for $35 minus commissions. So you continually do that every single week, and those numbers add up, especially if you have a more volatile stock. You can get higher and higher numbers for bigger and bigger increases. You got any more questions about call options? Let me know in the comments below. Trying to make some money out there, guys. See you next time.
Give me a sub.